Stop what you're doing for a second, because the story unfolding right now isn't just another headline. It's a warning flare. It's a countdown. And if you've been watching the dollar, watching gold, watching silver, watching the way governments talk when they're getting nervous, then you already feel it. Here's the punchline up front. 2026 is shaping up like the year where the cracks stop being hairline and start becoming visible from space. The kind of year where people look back and say, that was the moment it turned. And yes, we're going to talk about gold and silver. We're going to talk about the Middle East. We're going to talk about why markets can look calm right before they go feral. And we're going to connect the dots that most people never connect because they're too busy arguing over symptoms while ignoring the disease. But before we jump in, I need to be real with you for a second. My channel analytics are screaming something at me. A huge chunk of you who watch these videos, you're not subscribed. You're here, you're learning, you're getting value, and then you disappear like a ghost. If this content helps you even a little, do me a favor, hit subscribe right now. We're aiming for 50,000 subscribers in the next 30 days, and I can't hit that target without you. Also, we're now posting members exclusive videos on a regular basis, and this isn't recycled content. A dedicated team is working behind the scenes to build these deep dive updates only for you, our special members, and the John AG family. If you want in, click the join button right now or use the link in the description. All right, let's get into it. The year opened with chaos on the geopolitical stage, and the loudest alarm bell has been Iran. Social media is flooded with the same recycled script. Intervene, save the people, restore freedom. The words change, but the movie is always the same. And the problem isn't that people care about suffering. The problem is that the narrative is being packaged like a product sold with emotional urgency, and almost nobody stops to ask the most important question. Who benefits? Because here's what happens every single time. Step 1, paint the target as a cartoon villain. Step 2, flood the public with moral language so questioning the plan feels like a sin. Step 3, when the first missiles fly, pretend nobody could have predicted the consequences. And then years later, act shocked when the region is worse off. Refugees surge, energy prices jump, and the currency printing goes into overdrive to fund emergency spending. If you've seen that cycle once, you've seen it 100 times. And that's why I reached out to a veteran trend forecaster, someone who has spent decades tracking the rhythm of empires, the timing of wars, and the way markets react when confidence cracks. I asked him a simple question. Are we actually on the edge of a direct strike, or is this just noise? His answer started with a rewind. You can't understand what's happening in Iran by starting in 2026. You have to rewind the tape. You have to remember that Iran didn't become suspicious of the West in a vacuum. There's a long memory there, a scar. And when a country has a scar, you can't talk to it like it's a blank slate. He pointed to the mid-20th century moment that still echoes today. A democratically chosen Iranian government moved to reclaim control over its own resources, especially oil. And suddenly outside intelligence services decided that was unacceptable. A covert operation later, the government was replaced and a friendly strongman was installed. That regime built a feared security apparatus and the population lived under it for years. Then, when the backlash finally erupted, the West acted surprised. But what did anyone think would happen when people are told for generations that their sovereignty is negotiable? Now, pause right there. I'm not asking you to pick a side. I'm asking you to notice the pattern. When people are pushed, cornered, sanctioned, and humiliated, the backlash doesn't stay polite. It hardens. It becomes distrust. It becomes nationalism. It becomes radical politics. That's not a defense. That's cause and effect. And here's what makes this moment especially dangerous. The public conversation is being framed as if there are only two options: do nothing or launch bombs. That's a trap. It's a false binary designed to pull you into supporting escalation. So, are we on the edge of a direct U.S. strike on Iran? The forecaster's answer was uncomfortable because it wasn't theatrical. It was practical. He said, watch the calendar. Major actions that could shock markets are often timed when liquidity is thin and attention is split. Weekends, holidays, late-night cycles. Not because it's cinematic, because it's strategic. If you want to control the first reaction, you hit when people can't react normally. And if you think that's cynical, ask yourself why so many huge announcements are made when markets are closed. Now, this is the part where people roll their eyes and say conspiracy. But you don't need a conspiracy to understand incentives. You just need to understand that institutions protect themselves. They protect narratives. They protect positioning. They also protect portfolios. Because when you zoom out, war isn't just a political decision. It's a financial event. If the regional conflict expands, energy supply risk explodes. Oil doesn't need to physically disappear for the price to spike. Risk premiums alone can do it. Insurance costs, shipping routes, panic buying, speculative runs, it all stacks. And when oil spikes, it doesn't stay in the oil market. It bleeds into food, it bleeds into transport, it bleeds into manufacturing, it bleeds into inflation expectations, it bleeds into interest rates, and then it bleeds into your daily life. That matters because oil is still the bloodstream of global trade. And when the bloodstream is threatened, every asset feels it. Here's where the conversation got even darker. He warned about what happens when nations feel cornered. When leaders believe they're facing existential defeat, the temptation to escalate becomes irrationally strong. History is full of last resort decisions that looked unthinkable, right up until they happened. That's why gold and silver don't spike when things are good. They spike when the world starts pricing in the unthinkable. And while you're watching Iran, don't ignore the second storyline that flew under the radar for a lot of people, the dramatic operation involving Venezuela's leadership. You're told it's about justice. You're told it's about crime. You're told it's about cleaning up the hemisphere. And then almost casually, the language shifts. Suddenly, it's not even subtle anymore. It's about oil. Let's be adults. Countries don't spend blood and treasure to chase slogans. They chase strategic resources, strategic routes, strategic leverage. Venezuela has oil. And when a nation has oil, it doesn't just have a commodity, it has influence. Control the oil and you control bargaining power. You control pricing pressure. You control downstream industries. And yes, you influence currency demand patterns because energy is still one of the most traded necessities on Earth. Now, I'm not going to sit here and pretend every move is a chess masterpiece. Some of it is ego, some of it is politics, some of it is chaos. But the direction is clear. The world is sliding toward a more open, more blunt version of power. No more euphemisms, no more polite wrapping paper, just raw leverage. And that brings us to the third flashpoint that sounds almost absurd until you see how it fits. Greenland. If you hear Greenland and your brain says that's random, that's exactly why it's effective. Because the public dismisses it as a meme. Meanwhile, the strategic reasons are real. Geography, shipping lanes, military positioning, minerals, and the long-term chessboard of the Arctic. In my conversation, the forecaster didn't claim certainty about whether an invasion would happen. He said something more valuable. Unpredictability itself is now a feature, not a bug. When leadership signals that the only limit is my own judgment, the world has to price in volatility. Even allies have to treat you like a variable. And variables don't get trust, they get hedged. That's what's happening. The world is hedging. Now, here's the cliffhanger you need to hold on to because it connects everything we're talking about. When the world hedges, it doesn't just buy a little insurance. It rearranges its entire behavior. It changes how it holds reserves. It changes how it settles trade. It changes how it prices risk. It changes what it considers safe. And that shift is exactly why gold and silver have been acting the way they've been acting. And this is why he kept using one phrase, wild card year. Because in a normal year, policy looks slow, bureaucratic, predictable. In a wild card year, policy looks like impulse. One statement can move currencies, one rumor can move oil, one late night announcement can erase a month of calm, and you can already see that tone shift in how leaders talk about territory, resources, and national interest. Things that used to be whispered in diplomatic language are now said out loud. Even if nothing happens militarily, the threat itself becomes leverage. Now zoom out. The global economy isn't solid everywhere. You see pockets of strength sitting on top of weakness, consumers stretched, businesses cautious, and major regions flirting with recession. That matters because fragile economies are more sensitive to shocks, and leaders have more incentive to redirect attention with external drama and emergency programs. And emergency programs are where the money printer goes from hum to scream. So when you hear escalatory talk, don't just think geopolitics. Think budgets, think deficits, think bond markets, think who's buying the debt and at what price. Because the bond market is the silent judge. If bond buyers demand higher yields, governments pay more to borrow. If governments pay more to borrow, they cut spending or print more. If they cut spending, growth slows and tensions rise. If they print more, currencies weaken and commodities surge. That's the fork in the road. And neither path is painless. Now, let me give you a quick reality check segment because people get trapped in extremes. Extreme 1, everything is fine. Stop worrying. Extreme 2, the world ends tomorrow. Panic now. Both extremes are useless. The smarter approach is to assume higher volatility and plan like an adult. You don't bet your entire future on one outcome. You build resilience. Resilience can mean lowering bad debt. Resilience can mean building a cash buffer for real emergencies. Resilience can mean owning some hard assets. Resilience can mean diversifying across real things and not just digital promises. The forecaster also made a point about modern conflict that's worth hearing. It isn't just tanks and jets. It's drones, cyber disruption, sanctions, payment systems, shipping choke points, propaganda, and sabotage. Everything that can break confidence without a traditional battlefield. And when conflict becomes everywhere, markets can't price it cleanly. That's when you get jumps. That's also why precious metals get bid even when the stock market looks okay. Metals are a hedge against uncertainty itself. Now, a quick word on sanctions because they're treated like a magic wand. Sanctions don't only punish governments. They reshape incentives for entire populations. They create alternative trade routes. They encourage new alliances. And sometimes they accelerate the very behavior they were meant to stop because nations learn to reduce dependency. And reducing dependency is another way of saying less automatic demand for the dominant currency. Now, I promised you a retention hook. So here it is. There's a psychological signal that often shows up right before confidence breaks, a sudden synchronized obsession with saving the public through intervention. When that language intensifies everywhere at once, especially alongside financial stress, it can be a sign that bigger moves are being prepared. Not a guarantee, a sign. Now, let's drop in a viewer question segment because this is exactly what you should be asking. A viewer asked, if the dollar weakens, does that automatically mean gold and silver go up forever? No, nothing goes up forever in a straight line. Metals can correct, metals can consolidate, metals can shake people out. That's normal. But the bigger point is this. In a long currency devaluation cycle, hard assets tend to win over time because they're not someone else's liability. They don't depend on a promise being kept. So the real question isn't, will there be pullbacks? The real question is policy moving toward sound money or toward more expansion? And if you've watched the last decade, honestly, you already know the direction. Now let's touch the AI angle quickly because it loops back into metals and currency pressure. AI has become the new story that justifies spending, valuations, and political hype. Everyone wants to look innovative and nobody wants to miss the next big thing. That creates a feedback loop. But feedback loops become bubbles when people buy because everyone else is buying. And AI isn't just a tech story, it's a power story. Whoever controls infrastructure, chips, energy inputs, and talent pipelines controls leverage. Competition increases spending. Spending increases deficits. Deficits increase pressure on currencies. See how everything loops back? Now, one last point. People underestimate how quickly mood can change. You can go from buy the dip optimism to get me out panic faster than you can refresh a screen. That's why preparation matters. Okay, now reconnect this to the main line. Iran tension creates oil risk. Oil risk creates inflation risk. Inflation risk pressures central banks. Central banks get trapped between markets and prices. That trap weakens confidence in policy. Weak confidence pushes people toward hard assets. That's the chain. And if you're waiting for a neat headline that says the transition has begun, you'll be late. Transitions happen quietly, first, and then suddenly. And that's why the forecaster kept coming back to the idea of a multipolar world. When more trade happens outside a single pipeline, demand patterns shift. It doesn't need to be dramatic. It can be slow, incremental, and still powerful. A few more bilateral settlement deals here, a few more commodity contracts there, a little more reserve diversification over time, and then one day the market realizes the default setting isn't default anymore. He also warned that once big players start acting this way, smaller countries copy it. Nobody wants to be last to the exit, and nobody wants to discover that their savings are trapped behind someone else's political decision. And here's the sneaky part. You won't hear this trend announced on television with a countdown clock. It's quiet, it's administrative, it's buried in agreements, policy notes, and technical adjustments, but the price of gold and the behavior of silver often react before the public understands why. That's why you're here. So when you hear people say, nothing has changed, the old order is permanent, remember this. Orders don't end with fireworks. They end with habits changing. And if the habit changes from hold dollars by default to hold dollars only when necessary, that's not a headline. That's a structural shift. And structural shifts are exactly what long-term investors pay attention to. You ignore them at your own risk, and you can't rewind time. Now, just before we go deeper, quick note. In the description, I put bonus links for you. Make sure you check them out. There's a premium WhatsApp channel link, and there's also a channel membership link if you want to support the work and unlock extra content. And also, small creative detour, if you're someone who loves silver and you want to hear real success stories from people who built wealth with smart moves over time, there's a link in the description to a separate channel dedicated to that. Go subscribe over there too and see how everyday people turn silver strategy into real results. All right, back to the main thread. So, why are gold and silver ripping higher? Most people answer that with one word, fear. And fear is part of it, but fear is shallow. The deeper answer is that gold and silver are signaling a shift in confidence. Confidence in currencies, confidence in stability, confidence in leadership, confidence in the future being predictable. When confidence breaks, people move. Not because they're greedy, because they're trying to survive the rules changing. Here's the ugly truth. When governments print, borrow, and promise at the scale they've been doing, the currency becomes a story, a belief system, and belief systems can crack overnight. The forecaster put it like this: the death of the dollar doesn't mean the dollar vanishes tomorrow. It means the trend has flipped. It means the world's willingness to treat the dollar as neutral, stable, and untouchable is weakening. And you can see it in the behavior. You see nations building alternative lanes for trade. You see more bilateral deals. You see more pressure to diversify reserves. You see a quiet preference for assets that don't come with permission slips. And you see it in the price signals because gold doesn't need a press conference to make its point. It just moves. Now, there was another part of his argument that caught my attention because it explains the speed of what we've seen. He said, we're living through the aftermath of the everything injection era. Think back a few years. The world froze, work stopped, supply chains snapped, and then central banks and governments responded with the biggest wave of stimulus most people have ever seen in their lifetimes. Interest rates were crushed. Liquidity flooded the system. Asset prices levitated. And the public was told that the inflation would be temporary. Maybe you remember the confidence, maybe you remember the smirks, and then the grocery bill happened, then the rent happened, then the insurance premiums happened, then the wait, how's everything expensive moment happened. That wasn't a surprise, that was math. And the reason I'm bringing it up is because the same tool that inflated the problem is the tool policymakers reach for when the system starts wobbling again. They don't have many levers. Their favorite lever is money. Lower rates, easier credit, bigger deficits, and a louder core is telling you it's for your own good. Here's the trap. Lowering rates can prop up markets in the short term, but it often weakens the currency. A weaker currency makes commodities look more expensive. And when commodities look more expensive, regular people feel it in food, energy, rent, and everything that keeps life running. That's the spiral. And once you're in it, getting out is painful. Now, silver has another layer that makes this even more explosive. Gold is mostly held and stored. It's a monetary metal first. Silver is a monetary metal, yes, but it's also an industrial workhorse. It gets used up. It gets scattered in electronics, solar tech, medical applications, and all kinds of modern systems. You don't recover most of it easily. It's not sitting in vaults like gold. A lot of it is gone. So when demand rises, the squeeze feels different. Think about it like this. Gold is a savings account for central banks and cautious investors. Silver is a two-golf war between money and industry. And when both sides pull at once, price doesn't move politely. It jumps. And then there's a second silver factor that people keep underestimating: psychology. When silver starts moving, it's one of the few markets where regular people feel like they can still participate. Gold feels expensive. Silver feels reachable. So silver can attract momentum in a way that turns a steady move into a surge. That's why the silver chart can look like a staircase and then suddenly look like a rocket. Now, let me slow down for a second and make this practical. When people hear dollar trouble, they often imagine a dramatic overnight event. That's not usually how it works. More often, it's a slow bleed. Less purchasing power, higher cost of living, more volatility, more political tension, and a growing gap between asset owners and wage earners. That's the real collapse. Trust decaying. And trust decays when people feel the rules are rigged. They watch bailouts happen for institutions while regular people get told to tighten their belts. They watch debt explode while promises get made that can't be kept. They watch leaders preach morality while playing power games. So they hedge, they buy hard assets, they diversify, they move money. Now, I know some of you are thinking, okay, friend, but what do I do with this? First, I'm not a mind reader. Your situation matters. Your risk tolerance matters. Your timeline matters. But I can tell you what the signal is. Gold and silver are not moving like this for fun. They're moving because the world is bracing. And if you're a long-term investor, the point isn't to chase candles. The point is to understand why the candles exist. Here's a simple framework the forecaster shared that I think is worth keeping in your pocket. When the world feels stable, people chase yield. When the world feels unstable, people chase safety. When the world feels unfair, people chase escape. Yield looks like growth stocks, leverage, and speculation. Safety looks like cash, short duration, and defensives. Escape looks like hard assets, real assets, and mobility. And right now, the escape category is getting louder. Now let's talk about the piece most people don't want to hear. Markets can stay irrational longer than you can stay emotionally calm. That means the system can look fine right up until it doesn't. The forecaster used a phrase I loved. It's the calm that should scare you. Because in a late cycle environment, calm often means complacency. Complacency means leverage. Leverage means fragility, and fragility breaks fast. Which brings us to the stock market. Everyone loves the rally when it's happening. Everyone loves the new era story. Everyone loves the idea that technology will erase cycles and then reality shows up with receipts. His view is that we're staring at a bubble that rhymes with past bubbles, but with a 2026 twist. You've got huge valuations. You've got massive excitement around artificial intelligence. You've got companies and funds allocating like it's risk-free. And you've got the public being told that this time is different. That sentence, "this time is different," has ended badly so many times it should come with a warning label. Now, let's be fair. AI is real. It will change industries. It will create efficiencies. It will destroy certain jobs and create new ones. That's not the debate. The debate is price. When people pay anything for a story, the story becomes a bubble. And bubbles pop when the story hits friction, earnings, costs, competition, regulation, geopolitical shocks, or plain old exhaustion. He also pointed to a global reality that gets ignored when people view the world through one country's lens. The 20th century belonged to one dominant economic model, but the 21st century is multipolar, whether people like it or not. You can argue about who leads, but you can't argue that the competition is real. You see it in manufacturing, you see it in education output, you see it in infrastructure, you see it in the speed of adoption, and you absolutely see it in technology. So when investors price the future as if a single region will own the entire narrative, they're underestimating how fast competitors adapt. Now, will the market crash? He refused to give a cute percentage prediction because that's what people do for clicks. Instead, he gave a framework. The larger the leverage, the faster the break when the trigger hits. And the trigger could be something as simple as a credit event or as brutal as a war shock. Because here's the nightmare scenario. If a major conflict expands in the Middle East and oil spikes sharply, inflation pressure returns with a vengeance. Central banks then face an impossible choice: fight inflation and crush markets or support markets and let inflation run. Either path creates pain, and pain is when bubbles stop being theoretical. Now, I want to add something here that I think most investors underestimate. The market doesn't need a perfect reason to fall. It just needs an excuse when positioning is crowded. When everyone is on the same side of the boat, a small wave can flip it. That's why you should pay attention to sentiment, pay attention to leverage, pay attention to the confidence that nothing can go wrong. Because the moment you hear nothing can go wrong, something is already going wrong. Now, since we're talking about narratives, let's talk about the media layer. You might have noticed something. The same handful of talking points get repeated everywhere with the same tone, the same framing, the same approved emotions. That's not an accident. Over time, ownership concentrates. Smaller voices get bought, merged, or buried, and the public gets one narrow window of interpretation. That matters because markets move on perception before they move on fundamentals. If the public is told everything is fine, they stay exposed. If the public is told everything is doomed, they panic sell. If the public is told this asset is